You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Education Wednesday once again. The day on our broadcast week here where we start to break down all of the fun, interesting, scary, arcane, all of the above adjectives, throw them together, option strategies that you guys can use in your own portfolio. Maybe you're a beginner stock trader and you're starting to look at those options things. Maybe you've been trading options for a little bit. Maybe you're thinking about dipping your toes in those waters, but you're a little bit concerned about it. Either way, we got you covered here. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network upon which so many of you are binging. Remember, I know a lot of you like the Options Bootcamp direct feed. You like to get it right in your veins. That's cool. Hey, we love all of you. But, of course, if you're just doing that, you're missing out on all the other nearly dozen shows we do here on the network, including other shows you guys may like, particularly for this audience, like Options Playbook Radio, another great one for your beginner options traders out there, as well as, of course, maybe a little bit of the option block for a little bit more advanced traders out there. Of course, Volatility Views, if you like all things volatility and VIX. If you're into crypto these days, and hey, who the heck isn't? The Crypto Rundown every Monday as well. We got TWIFO this week in futures options. If you're interested in silver, that was a big one of late. Oil, natural gas, all these things that have been lighting it up, gold, and a whole bunch more, including equities, then that's the show for you and a whole bunch else smattered there in between. Great interviews, everything else. So wherever you're getting the Options Bootcamp show, make sure you upgrade to the full kit and caboodle over there. Wherever you're getting it, get the full network. And, of course, keep those questions and comments coming, too. We do love to hear from you guys and gals out there. And let's see who we're hearing from on the old program today. It's my compatriot, my partner in crime, the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker, mentoring longtime options educator and author of one or two or half a dozen options-oriented tomes. Mr. P, welcome back to Options Bootcamp, sir.
Hey, Mark, it is so good to be back as usual, back in the saddle again. Can we get like a little clip of that song maybe, or do we got to pay those guys for that?
Probably got to pay them. They're pretty hardcore, especially on the YouTubes. Most other platforms you can get away with it. YouTube, you're yanked off in about 12 seconds. But other than that, I think we'll be good. Before we get into all the basic training stuff, Dan, these are crazy, topsy-turvy, tumultuous times. I don't think 2021 got the memo. It was supposed to be the quiet year, the quiet, tranquil sibling to the madhouse that was 2020. And yet so far, a couple of months in, 2021 is doing its darndest to one-up its sibling from last year. So we have a lot of vol movement. Markets were selling off pretty furiously yesterday. They're rallying pretty hard today. We've got just madness afoot. So I think before we kick it off, let's do a little quick, timely discussion, because a lot of people have this on their brains these days as well. We get a lot of questions about this stuff, which is, what's the scuttlebutt? What are folks into over there? What are they talking about over there in the land of MTM? What are they coming to you in types of questions? And what are your thoughts on what we're seeing out there from an overall volatility perspective, from these crazy market valuation levels? Of course, everyone's got crypto on the brain these days. So if you have thoughts there as well, the intersection of Bitcoin and Tesla, and what trades are really hot over there in MTM land these days, sir?
Yeah, there's a lot of craziness. It's kind of interesting. I've been seeing the income trade make a comeback, which, obviously makes a lot of sense. When you see, I mean, don't get me wrong, like we have periods where we get some dips like we had, the last couple of days. So far, they've recovered. But when we get those periods where the market kind of like steadily climbs up with an occasional dip here or there and implied volatility being overpriced, for extended periods of time, that's what you're going to see. You're going to see those income trades come right back and gain popularity because they work.
They do indeed. They do indeed. No, I want to get your thoughts on something else. We just did an interesting poll. Of course, VIX has been fluctuating like mad, spiked up yesterday on the big sell-off news. Now today coming in, it's coming back down again. There's been a lot of talk. We saw it flirt ever so briefly shy of the 20 handle about a week and change ago. That was, of course, the first time in about a year, pretty much since the pandemic really kicked off in earnest, that VIX closed below 20. It was 1997, so it wasn't a big close below 20, and it shot right back up the following Tuesday. But still, it was interesting to watch. So we asked our audience, Dan, VIX just closed below 20 for the first time in about a year. Is this a sign of things to come, or is it merely the calm before the storm? Quite simply, what do you think VIX will be trading at? Where will it be a month from now, above or below 20? And our audience, Dan, came in right about 2/3, 68.6%, saying above 20. So they're buying in a little bit more vol, and obviously about a third, 31.4%, saying below 20. I'm curious, sir, what are your thoughts on that? A, and B, more importantly, what do you think about what our audience, are you buying what our audience is selling, sir?
It's an interesting point and an interesting question. And it's a tough one. I think that, anything can surely happen, but I am going to buck the trend a little bit. I'm going to take the other side of this and say below 20. And I'm not saying that with 99% confidence interval, but, when you have Jerome Powell and basically anybody who has any power saying, look, man, we're just going to keep flooding the market with money. We're going to have reflation, and, that means assets get worth more and stocks are assets. That's just going to be good for stocks for a long time. And when stocks steadily climb, implied volatility falls. And you don't have to go back too far in history, 13 years ago to 2008, to see how that played out. 2008 thing happened, Lehman and, all that. Fed cut rates, kept them low for a long time, and the market went up and vol was squished. So I think there's a lot of likelihood that something similar to that is going to play out. And it almost just economically has to.
One would think, given the fact that we've been in rally mode for the better part of a year since last March, pretty much, for the most part, a few breaks in between there, but for the most part, you're right. And yet VIX has steadfastly, and some might say stubbornly, remained above 20. What are your thoughts? Did you vote in our poll? A lot of people did. If not, hit us up. Let us know what you think. Meanwhile, it's time for us to roll on into our basic training.
All right, boot in. It's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, prepare to learn.
Yes, the basic training. Sounds so festive, Dan, even though it's in the midst of winter here in Chicago. I feel like it's 4th of July whenever we do this show. And Dan, basic training, of course, a portion of the show where we break down some basic options concept and strategy, technique, and explain how you can utilize it in your own portfolios. And Dan, they don't get much more basic than this. We're talking about puts, to put or not to put. That is the question. And why are we doing that? Well, we had an interesting question from one of our listeners. Actually came into this show, but I knew we didn't have a boot camp scheduled for a while. So we discussed it on some of our other programs in the interim because it's an important question. And clearly, a lot of people have this on their brains. And so I wanted to get it back to the show that it initially came into, and also because it's ideally suited for the audience of this show. So get ready for a little bit of story time, Dan. This comes from Jeff Davis. He says, "Hey, options insiders. I have a cautionary tale about exercising put options. Here's the story. Last Thursday, I decided, what the heck, and bought a one-lot put at $65 on GameStop. This was back a few weeks ago, listeners. It was still a little bit higher than it is right now. He said the bubble seemed to be popping, and I figured it'd be a fun and responsible way to play that casino without too much on the table while limiting my downside risk. Toward the end of trading on a very rocky Friday, I found myself watching the stock bounce around in the low 60s. With my put barely in the money. Ordinarily, I've had shrugged my shoulders and closed out for what little premium was left. In this case, however, there was a fair chance that such a volatile stock could drop even in the last couple of minutes of trading, vastly improving my position. So I held on throughout market close, and the option auto-exercised just in the money. I think you can see where this is going, Dan. I did not actually own any shares of GameStop, though I did have adequate funds to purchase them. My understanding of exercise put options is that the brokerage would secure shares on my behalf, put them to someone else's account at the strike price, and hand me the difference in cash. Unfortunately, Jeff and everyone else, that's not how it works. We'll get to that in a second. He says, imagine my surprise when, before going to bed very early Monday morning, I saw the broker app that he used still had my game position open, marking it anew with a loss of hundreds of dollars. Game was now trading in the low 70s. Then I looked closer, saw the little red minus 100, and realized that I was now short 100 shares of GameStop. Yes, that is how puts work. Fortunately, I was able to close out at some point in before market trading to eliminate that risk, but I did eat the net loss. If I had bought a higher lot count and or if GameStop had spiked severely early Monday before I could take action, this could have turned out a lot worse. I'm wondering if you guys could elaborate on exactly how brokerages implement the exercise of put options when you don't own the underlying. Specifically, how is this implementation affected by market conditions and brokerage policy? And what, if anything, can traders do to establish their exercise preferences with their brokerage? I hope this will prove helpful to others. Yours, Jeff. And Jeff, this, I think, will prove helpful to others. Let's start there, Dan. I know that was a bit of an epic tale. Sometimes your attention wanders when the tales get epic and the treatises get long, but that's an interesting one. What are your thoughts on Jeff and perhaps his misperceptions of how puts work, sir?
Yeah, man, options are, they're just a little bit more complicated than just like buying a stock, although there's some tricky things that can happen just with buying stocks too. And it's really important to understand every part of what you're doing, and not just, and look, like you can get into real nitty gritty. Like we did that one episode on second order Greeks and stuff like that. Like, sure, you can get that deep, but you don't have to, but you do really have to understand how they work. And a put, like the first thing you ever learn about a put is just the plain old definition. A put is the right to sell the underlying stock. Don't read anything else into it. Don't think that means somebody's going to buy it for you to sell. You have the right to sell it. If you don't have it, that results in a short position. So, I'm going to tell you, Jeff, you got lucky, man. Brother, I've seen tales firsthand where people didn't understand something, and sometimes it's something a lot more complex than this, that resulted into thousands, tens of thousands. I can tell you firsthand about literally hundreds of thousands of dollars of a loss when there's some little tiny nuance that isn't understood. So just take it as a lesson, man. Lick the wounds. You learn something that what doesn't kill me makes me stronger, and keep at it.
Yeah, Dan's right. That could have been a heck of a lot worse. We saw with GameStop, it was $500 not too long before your trade. So imagine you came in and now that at negative 100 shares is up at $500 or somewhere thereabouts. That could leave a big mark. So that's why this stuff is important to understand. So we're going to do a quick put refresher. We've obviously done many deep dives on puts on this program, including very recently our recent episode, WTF, Are Puts So Expensive? Check out that one if you want to know more about that as well. But obviously, we have seen the numbers. There are a lot of new people joining the network, joining this show, joining the world of options in general, who still have issues with the early, or they just don't understand all the concepts. So that's what we're here for. That's exactly what a show like this is about. So let's walk it through again. As Dan said, what do you get when you have a put? You have the right, but not the obligation to sell that particular underlying at the strike price. That's the price where your option is set at. And so let's go through an example. Anytime during that option's life. So let's go through an example here. Let's say XYZ, everyone's favorite, trading $100. You think, or maybe you own it, or maybe let's just say in this case you don't. You just think it's going to drop below 95 in this case. So you buy the 95, 1 month, 95 strike put. You pay $1 for that put. So what do you have now? And what happens? Let's see. So XYZ stays above 95 bucks. That put really isn't very valuable to you because you're not going to exercise it and sell the stock at 95 when, let's say, it's trading at 98 or 99 or 102 in the market. You're obviously better off doing that than selling it at 95. So if the stock trades above 95 for the lifespan of that option, that put's going to expire worthless. It's never going to really amount to much for you. Where it gets interesting is where in Jeff's example, it drops below, or in this case, maybe hovers around 95. And once it gets to that 95 strike, as Jeff discovered, if it expires 1 cent in the money, you will be exercised there. We'll get to all that fun stuff in a second. But effectively, if XYZ drops below 95, you have that right at any time to exercise that put and sell it at 95. That means the stock could go effectively to zero. You still have that put in your back pocket. That's why puts are so useful and so valuable at the end of the day. At the end of the day, they're really the only contractually guaranteed inverse correlation in the market. Look at anything else. I don't care what it is. Bonds, crypto, volatility, pick your asset class. They have degrees of inverse correlation that vary all the time, depending on the market, depending on situation. Go back and look at the madness of last March. We did that on our TriPro program. We did cross-asset correlation for a variety of different assets. Spoiler alert, when it all hits the fan, correlation goes to 1. You know where it doesn't go to 1? It with a put. The put is your contractually obligated inverse correlation. You know for the life of this option, you could sell an XYZ stock at $95. It's a nice little thing to have in your back pocket for a rainy day. Now, what happens when you get close to expiration now? That's what happened in Jeff's example. On expiration, the stock closes even 1 penny in the money, which is effectively what happened to Jeff there. You will be auto-exercised. What does that mean on the puts case? In this case, you will sell 100 shares of XYZ, or in his case, GameStop. Now, there's a lot of misperceptions around that. You don't need to own the stock to sell it. If you have the shares in your account, your brokerage will sell them, so you won't have to worry about getting short. But if you don't have the shares, as was Jeff's case, you will be short 100 shares of the underlying for every 1 contract. So in this case, let's say we bought a 1 lot, we'll come out short 100 shares of XYZ at $95. Now you could see in something like a GameStop, which is highly volatile, how if you had an unanticipated short position come in, that could be a little bit disconcerting and also quite a bit risky. You wake up on Monday morning, wait a minute, I didn't know I was short this stock that was just at 500 a few minutes ago. So bear that in mind. You will get short if it's a penny in the money, which is why we say all the time, going into expiration, close it out if you don't want this, or if you don't want to be stuck with these short positions in the case of a puts, or a long stock position in the case of a call, then just close it out. And it's doubly important for shorts. You want to close those out going into expiration. You don't want to mess around with things that are bouncing around the strike at settlement. Another myth out there that if you don't have enough capital in your account to cover the margin for, in this case, shorting 100 shares of the stock, that you won't have the short position. No, your broker will still put that short 100 shares of stock in your account. And what will happen is you'll have a couple of days for you to come up with the money to cover it. Otherwise, they will close that out. So you still have a few days of naked risk in your account. It could work out in your favor. This XYZ could drop to 20. You can make a ton of money, or it could shoot up to 1,000. You never know. So it's unanticipated, unplanned risk. So why are you buying these things? Again, at the end of the day, we talked about it before. It's the only contractually guaranteed inverse correlation out there. The cons of puts, as we talked about on our Why Are Puts So Freaking Expensive episode, puts can be freaking expensive, and they're getting kind of juicy right now, looking at how lofty these valuation levels are out there. Another question we get a lot, Dan, since we're talking about puts versus stop orders. What's the deal? I mean, puts are expensive. Stop orders are free. Why should someone use a put, Dan, instead of just the old school stop order?
Yeah, it's because of that gap risk. Like puts protect you on a per delta basis before expiration, where stop orders, like say you have a stock that you own at 100 and you say, I'm going to put in a stop to sell at 97, good till cancel. And tomorrow the stock opens at 60. Well, guess what? You're getting filled at 60, not 97, because the stock never traded 97. It gapped. But if you own a put, you're protected. So it's just seamless, flawless protection. But, like Mark said, you pay for it.
And speaking of paying for things, obviously a big issue with puts. How can you mitigate that payment? We've done many episodes on that as well. Go back to our archives, listeners, and spend some time. It's quality time well spent. A couple of ways you can do that. The basic way to reduce your outlay for a put, we just spent $1 for that 95 put in our XYZ example. Maybe we're only really worried about a near-term downside to, let's say, around the 90 handle there. So let's, instead of buying that 95 put and have all that downside that we're paying for, let's mitigate that outlay. Let's buy the 95-90 put spread instead. And say in our example now, the 90 puts trading about 50 cents. So now you buy one for $1, sell one for 50 cents. You've actually cut your outlay in half at that point, and you have the risk you're worried about still covered, still protected there. Collars are another way you can mitigate the outlay for these puts. That's buying an out-of-the-money put, and of course, selling an out-of-the-money covered call against a stock position, usually. That's why it's called a collar. And that's another way to do it. You can also have collars with put spreads, combine those two positions we just talked about. So you have the put spread you bought. So you're selling one put against the put you already bought. Now you're also turning around and selling out of the money covered call as well. So you have two effective short legs against that one long option leg. And that combo usually will go a long way to paying for the cost of that put as well. You have other things. You can do ratio put spreads, buy one, sell two. Now that's where things get a little bit dicey because, of course, you're naked short and extra put in that situation. So you have to be comfortable wherever you're selling to, picking up that underlying at that level. And of course, you can go beyond that, beyond the ratio put spread to the simple put butterfly, buy one, sell two, buy one farther out of the money to hedge against the worst case scenario coming to pass. Dan, in your situation, obviously you've encountered this a lot over there at MTM. What are your thoughts on your preferred ways to tackle that age-old question of how do I pay for my puts?
Yeah, I mean, I'm a little bit less of a fan of put spreads and ratio put spreads and put butterflies, only because since puts are so expensive, the only reason I would even consider buying them is if I'm protecting against a pretty darn good move, like I'm willing to absorb a 1, 2, or 3% move, no problem. I'll accept that because a put's going to cost me at least that. So I don't know. One of the ways I like to do is just to be decisive. Hey, look, stocks are at an all-time high. Just hypothetically speaking, this particular stock is at an all-time high. I had a pretty good run with it. Implied volatility is really low. I'm going to buy a put and just give up some cash, and that's okay. Because the problem with all those things I mentioned, put spreads, ratio spreads, put butterflies, is it protects you until it doesn't. And when that worst case scenario happens, it's a craptastrophe, Outside of that, the only way that I do like to finance puts is with collars, particularly split time collars. But, like you have to have a little bit of skill to manage those, a little bit of experience. Not that they're like ultra hard, ultra cerebral, but like they're not really set it and forget it. You've got to have a little bit of a knowledge base to do it.
Well said, sir. Unfortunately, that music needs to come to the end of episode 1, but let's recap here before we go what we're talking about. Puts, the mysterious put. So yes, if you buy a put on your underlying and it expires even a penny in the money, you will get on most of the underlyings that you folks out there are trading, you will get a short 100 share position. Obviously, is going to change with the contract specs and other things. If you go out into, let's say, a futures options, for example, the multipliers and everything else are going to be different. We're talking about most of your standard equity options. Here, you're going to get that short position, so be prepared for that. Your broker is not going to go out and source other shares and put them to someone else and then give you the difference or anything like that. You will be short. Now, I should point out, you can contact your brokerage firm and say, hey, if this ticks in the money, I don't want these to be exercised, contra exercise orders. You can give those to your brokers. Most brokers will make you call up, though, to do that. Most of them don't let you do that online. They don't want you to actually talk to a person. So if that is a situation, if you're like Jeff and you're seeing something vacillate around, then you want to maybe take a chance, add an extra bit of juice, but then, maybe for some reason you decide you don't want to do it after all. I think in that position, you still sell it out. But if you want to have it on and then still not exercise it, for whatever reason, you can call your broker and do that. So that's something you have to do. You have to be proactive, but you can do that. But if you have those puts, if you buy them, they expire in the money. Get ready to have that short position in your account or to have shares that you own be sold at the strike price of that option. That's the basic functionality of puts at the end of the day. Listeners, again, if you want more about puts, and hey, who doesn't in these crazy markets, check out the archives of this show on Options Playbook Radio. We'll keep you busy for days with all things puts. We even have a playlist over there on our YouTube channel about protective strategies, so you can get into all that if you want as well. And Dan, before we go, if folks want to reach out to you to talk about maybe that split time collar thing you were just talking about or any of these other types of strategies, where should they go? What should they do, sir?
Make your way over onto my little piece of the internet, markettaker.com. That's market, like stock market, taker, like take what is rightfully yours, 2 T's in a row, markettaker.com. And that's how you can contact us, and I'll be glad to help any way I can.
There you go, markettaker.com. But you don't have to go anywhere if you're listening to us live. We'll be back in exactly a couple of seconds with episode 2. Otherwise, you got to wait till next week for our next episode of Options Bootcamp.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.